Hello and welcome. We are Group 1 and today we'll be looking at the extent to which accounting earnings and book value information is value relevant. To begin, I'll be giving a brief introduction into value relevance, followed by Sean, who'll be looking at relevant versus less relevant side of accounting earnings. Rickard then will be looking at the valuation techniques of this. Next, Edwin will take us through book relevance and its relevance, book value and its relevance, followed by Jeneline, who will take us through factors affecting the relevance function. Andreas will explain the explanatory power, which is all to do with accounting variables. And finally, Sophia will take us through evaluation and the conclusion. Value relevance is defined as the ability of information disclosed by financial statements to capture and summarise firm value. Accounting information is seen to be value relevant if there is a statistical relationship between the accounting variables and market values of equity. In many studies, the Olson model 1995 has been adopted to explore relationships among the market value of equity and two main financial reporting variables, namely the book value of equity per share and earnings per share. Market value is related to book value and EPS by using this model. Since it is able to ascertain security prices and returns, the information content of accounting numbers is one of the most fundamental issues in finance and accounting. Ball and Brown, 1968, found that unexpected earnings are significantly related to abnormal stock returns. Therefore, many researchers have examined the information content of accounting numbers in various markets. The main purpose of financial statements is to give a true and fair view of a company's operations and financial position. If there were no relationship between firm value and numbers in financial statements, such statements would have no relevance. If financial statements lose the value relevance, nobody will have any interest in them. The value relevance of earnings is typically studied by regressing the stock return on accounting earnings or the abnormal stock return on unexpected earnings. Both measure the sensitivity of the earnings response coefficient. However, the two are not equivalent. Whilst the first tests general sensitivity of stock prices, the second focuses on unexpected or unusual parts of stock price changes and earnings.
I'll be talking about the relevance and non-relevance of accounting earnings today. Firstly, the adoption of IFRS. The adoption of IFRS allows harmony in financial reporting among many countries today. This allows potential investors and investors to make a clear and informed decision between different firms as it follows a stringent and clear guideline for firms today. Moving on to equity valuation, accounting information has value relevance for it when it comes to using information to estimate the value of a firm through the use of valuation model, which would be emphasized by Rickard on the next slide. I'll be moving on to accounting earnings and dividend payments. Information about current earnings could alter the expectation with a firm's ability to pay dividend in the future, and this would lead to an adjustment in stock prices. Moving on to future earnings, to current accounting earnings. An example could be using accounting information such as revenue to forecast future quantities and sale prices which vary due to a firm's marketing strategy, such as their customer base and competition in the industry. I'll be moving on to intangibles. According to Skinner 2008, through accepting that financial reporting model does not adequately deal with reporting of intangibles, it argues that it is untrue that technology-based companies have experienced problems in raising capital for investments in intangibles, citing the cases of Google and Cisco. These two firms have very high market value which rely on intangibles to actually generate profit. And now I'll talk about the non-relevance of accounting earnings. I'll talk about the timeliness of financial reporting. Much of the information released via accounting system is already outdated once it comes out. Thus, this gives outdated information to current and potential investors. And moving on to inherent discretion in financial statements, managers can actually cook the numbers to pursue their own personal goals through the manipulation of earnings management. And now fair value measurement. According to Ball 2008, fair value measurement has been a source of criticism as they might be on purpose or introduce volatility into the accounting system. And now moving on to intangibles. According to Amir and Leff 1996 and Leff 1996, financial accounting information is of limited value to investors when valuing service and technology-based companies that invest in intangibles such as research and development, human capital, and brand development.
Alright, I'm going to be continuing after Sean, except I'll be saying how value relevance of accounting earnings depends also on the valuation models. So for example, the PVED models and the price earnings ratio, earnings and dividends are influence a lot on the outcome. However, Alfred does say that in spite of extensive research, the factors that affect the relation between earnings and stock prices are still not completely understood. And he was referencing Lev Olson in 1982 and Foster in 1986. However, one way to make these estimates more accurate, referring to the price earnings ratio, is by using companies of the same industry with similar size as well as risk and return, and a similar growth rate in earnings. However, there is also another problem with using accounting earnings, which makes it less relevant, is the fact of uncertainty not just playing in the company's future positions, but also in the economies. And not just in the economy that a company may be working in, but also other economies around. So for example, as we saw with Brexit, when the results came out, lots of interest rates had gone up in worldwide, as well as currency conversion rates dropping down all over. Another problem with accounting earnings, which makes it less relevant, is that assumptions in certain models do not always hold, and there are factors that cannot be estimated. And this talks back to one of the first things that we're talking about, which was windfalls. Sometimes we can have more earnings in 1 year or less, and unexpected. However, Brown et al. In 1987 demonstrated that you can use multiple proxies for unexpected earnings, which will reduce the measurement error. Also, Sean had mentioned the convergence with the IFRS. However, the problem with that, although it does make the accounting earnings more relevant, is the fact that the US is still reluctant to drop the gap and adopt the IFRS. And this is a major problem because the US is the biggest market worldwide. So that will have major impact on the US adopting it or not. However, Bogopolsky, in his report, had said that it's very unlikely for the US to converge with the IFRS anytime soon.
Is book value information value relevant? Well, there are many variables that affect the relevance, and one of the main ones is that will depend on the company's financial position. Companies who have many assets like machinery, for example railroad companies, will benefit a lot more from book value than, for instance, a firm which trades a lot of its inventory and leaves minimum amount in the books. And in 1998, Barth, Beam and Landsman stated that the greater the amount of unrecognized assets, the lower the relevance of book value. Another reason that book value emission can be affected is the firm's size. And a study done by Brimble and Hodson in 2007 found that larger firms have higher value relevance of book usage due to more analysts following these big firms, as well as for the need of the company to disclose larger quantities of information in the books. Book value can also be used to determine if a company is potentially undervalued or overvalued by looking at the relationship with market value. Using price to book value ratio, investors can find out if a company is trading for less than its book value, signaling that assets could potentially be overstated.
Current accounting rules only record intangible assets in limited circumstances. Research done by Francis and Schipper shows that the average market-to-book ratio is 3.18 for high-tech firms versus 1.57 for low-tech firms. So financial accounting information may be not very useful when assessing the values of companies with large amount of unrecorded intangibles. Annually published financial statement may be considered to have high quality of timeliness in old times, but for current continuously changing business environment, it is insufficient for investors to value a firm by just reading through accounting figures. The last factor that makes book value information less value relevant is earnings management. Earnings management is allowed within certain ranges, and it is mainly categorized as earnings smoothing and use of loss avoidance to hide firm performance. Research done by Shan focusing on the listed companies in China for 2001 to 2005 also shows that earnings management adversely affect the level of value relevance.
Okay, let's move on to the explanatory power, R squared. So explanatory power had been used by several literatures to evaluate the value relevance of accounting system over periods of times. So according to Hale 2013, value relevance could be pinpointed through the explanatory power of accounting variables such as accounting earnings and book value of equity. Correlation explanatory power between accounting numbers and the measures of market values helps in evaluating the value relevance of accounting method. Moreover, this will also help in indicating any loss or gain of accounting variables over time. So, using ordinary least squared regression approach by Edward Bell Olson 1935, we could find the relation between market values and accounting numbers. As you can see from the formula coefficient, this is what we use to find how value relevance have changes over time. Here is a data research by Collins et al. 1937 regarding time series regression figure. So this figure actually illustrates the increasing value relevance of book value over periods of 1953 to 1993 has replaced the declining incremental value relevance of bottom line earnings. And similarly, a research by Keener 2001 regarding cross-sectional regression shows that book values has turned out to be more value relevant than earnings between the period of 1982 to 2001. However, it's best to note that the shift of value relevance will differ from countries to countries, and also industries and also other factors such as intangible assets that are being mentioned by Jenna Lin before.
Value relevance of accounting variables has altered over time, as well as the various factors that affect it. Value relevance research of accounting earnings has come a long way since Ball and Brown published their first paper on the usefulness of accounting earnings in 1968. As Carol Kimsack claims, reliance on value relevance as an indicator of comparative quality of accounting earnings necessitates the use of a unified, robust methodology. After Ricard explained the various approaches of valuation for accounting earnings and Sean drew upon the many elements of relevance, accounting earnings are definitely applicable if valued in a unitary fashion among corporations. Problems arise, for example, through the reluctance of the U.S. to adopt the International Financial Reporting Standards. Book value is one of the most straightforward ways to demonstrate a company's value, as one adds up the carrying value of its assets and subtracts its liabilities. Ultimately, there are many other factors to consider, such as the nature of these assets and liabilities, and whether the company is currently making profit or losses, but the book value is a good starting point when investigating a company. As Jenny Lean pointed out, there are faults in book value, such as that they can fail to keep up with the changing business environment. The book value can assist stakeholders drawing further assumptions, such as overall valuation, which Edwin discussed. Accounting earnings and book value are value relevant, but it seems that incremental book values have replaced incremental earnings values in terms of relevance. However, the level of relevance can be shifted and affected by factors such as the different working industries.